Well, hello again. Merle Dimbath, your conch economist. We're taking another good look at the investments of interest that we first noticed last week. We want to compare them now with the actual yield curve of the interest rates, anywhere from 1 year to 5 years, 10 years, and so forth. And we're going to look at the prices of those investments and the ETFs. And we're going to compare what we see today with what may happen next week after the Federal Reserve meets. There's a lot of speculation that they may lower rates, and if so, that's going to have an impact on the yields and on the prices of the various ETFs. So let's take a look. Okay, let's look at some interest rates and corresponding ETFs that yield a comparable rate of return. The Federal Reserve Fed funds rate, 3.88%, which is their target rate right now. There is an ETF called TIPS, which is an inflation protected fund, which we explained last week, and that's yielding about 3.13%. But let's look down here at some of the other periods of time. For example, the 6-month Treasury bill yielding 3.75%. There is a ETF that tracks the 6-month bill. It's called the XBIL, which is be the symbol on your computer. It's yielding 4.11%. Now notice that as we go out to 1 year, a longer period of time, surprisingly, the interest rate drops to 3.6%, and so does the corresponding ETF, which in this case the symbol is OBIL, 3.39%. Notice that's a lower rate of return than what the X bill. Go out to 5 years, 3.55, and there's a ETF IEI that's yielding 3.4. What's interesting is that after we reach a low point of interest rates there around 5 to 7 years, then interest rates start to climb. Notice the 5-year rate 3.55, the 7-year rate 3.89, 10-year 4.01, all the way to 30-year bond 4.67. The 30-year mortgage is 6.37. And notice over that period of time, the various ETFs also are increasing their yield. For example, the 10-year yield there on the TLH is 4.10. The 20-year, the TLT climbs to 4.29 and so forth. So we can see that these ETFs, they rise and fall as does the rate of return on Treasury bills. Now, why does the Treasury bill change like it does? Well, because of market factors. In a so-called normal market, we would expect to see a steady progression of higher interest rates from a short period of time to a long period of time. But as we can see, the 1 month yields 4.04 and the 5-year yields 3.55. Why? Well, because of market conditions. Now this chart shows very interesting information. We not only see what is the yield on the bonds, and we also see what is the yield on the corresponding ETF. But now I've included here the price of the ETF. And the ETFs vary. Now bear in mind, I have only shown a selection of ETFs. There are numerous, dozens of ETFs. So this is not a complete list by any means, but they do represent the point that we're trying to make here. Notice the 1-year Treasury bond yields 3.61%. The corresponding OBIL ETF yields 3.93%, and it's selling now at $50.17. The 3-year bond yields 3.49. The corresponding ETF, SHY, yields 3.86, and it sells at $82.81. And so on, looking out here to the 10-year at 402, and the TLH, which tracks that, yielding 4.10%, a price of $102.70. Now, what we will want to do a week from now, after the Fed meets, and if they do change rates, we're going to want to see what happens in all three of these columns. For example, what happens to the 10-year bond? What happens then to the corresponding yield on the TLH? And what happens to the price of the TLH? Remember our lesson from last week. We saw and demonstrated the inverse relationship between price and value. For example, if the TLH goes up in value from say 410, we would expect a corresponding drop in the price. But next week, if the Fed is successful in lowering rates, and if we see the rate of return on the 10-year drop below 4.02, and if we see the rate of return on the TLH drop below 410, we would expect to see an increase in the price. The 102.70 will increase in price, as will the price of all the ETFs. If the Fed is successful in lowering rates, we will see changes in the yields, and we will see opposite changes in the price. Now, bear in mind, sometimes we can see a different reaction in the short term, say a few months or a few years, to the long term, the 10, 20, 30 year. What's very important is the rate of return on the 10-year bond, because the 10-year bond influences greatly the 30-year mortgage. Now, right now, the 30-year mortgage is about 6.3% on a national average. We're going to want to see if, as a result of the Fed's work next week and their decision making, if they are successful in, number one, lowering the 10-year bond below 4.02% so that we can bring down the interest rate on the mortgage, on the 30-year mortgage. Well, this concludes my report to you for now. Please share this with others, and don't forget to subscribe. Join the Conch Economist next time for more Surviving the Waves of Economic Change.